Picture this. You wake up, reach for your morning coffee, only to find it's become a casualty of a global trade war. Sounds impossible, right? But that's exactly what unfolded when President Trump imposed a 50% tariff on Brazilian coffee imports. Overnight, the world's largest coffee consumer, the United States, saw shipments from Brazil, its biggest supplier, suddenly stopped at the ports. Reports say nearly 50 shiploads of beans were turned back in a single night, sending shockwaves through the coffee industry. Americans braced for higher prices, while Brazil wasted no time cutting billion-dollar deals with new partners overseas. Which begs the question, by going after its top supplier, did Washington just hand the future of your morning cup to someone else? As this story develops, we'll explore how this bold move may have backfired in ways no one saw coming. Coffee in the United States isn't just another drink. For millions, it's a lifeline. From that bleary-eyed first cup at sunrise to the midday boost at work, demand is enormous. According to USDA data, Americans consume over 24.5 million bags each year, about 10.8 pounds per person. That's a market worth nearly $3.7 billion annually, showing just how deeply coffee is woven into American culture. It's everywhere. Diners, gas stations, office break rooms, and of course, at home. For countless people, coffee isn't a luxury. It's a daily essential. Here's the reality. The United States can't grow coffee at any real scale. The plant needs tropical weather, altitude, and steady rainfall. Things the mainland simply doesn't have. Only Hawaii and Puerto Rico produce meaningful amounts, with a few small test plots in Southern California. But combined, their output is tiny, marketed as high-priced specialties, not nearly enough to stock supermarket shelves nationwide. That's why imports are essential, and why Brazil is so critical. Roughly 1 in every 3 cups of coffee in America starts with Brazilian beans. Colombia, the next biggest source, supplies less than a fifth of that. Brazil's dominance isn't by luck. With vast plantations, perfect climate, and over a century of expertise, it's the world's top producer, capable of shipping massive, consistent volumes at prices U.S. roasters love. Even the taste of America's coffee culture comes from Brazil. Its mellow Arabica beans are the backbone of countless blends, delivering consistency, mild flavor, and affordability. From Starbucks and Dunkin' to Tim Hortons' Maxwell House and Costco's Kirkland brand, chances are your smooth daily brew owes its taste to Brazil. But that heavy reliance comes with risk. Coffee trees take years to grow. There's no quick substitute if supply is disrupted. When Brazil's flow slows or prices rise, U.S. consumers feel it immediately at the grocery store or cafe counter. America's coffee culture has always been built on abundance and cheap prices. Remove Brazil from the equation, and that expectation collapses. By mid-2025, that fragile system was put to the test. On August 1st, Washington announced a sweeping 50% tariff on all Brazilian coffee imports, a move that stunned the industry. Overnight, the steady stream of beans that had fueled U.S. homes and cafes for decades was caught in political crossfire. The administration pitched it as a way to support American growers, but in practice, it was a high-stakes gamble that turned coffee into a weapon in a trade war. It was unprecedented, transforming a beloved daily staple into collateral damage. Suddenly, the world's largest coffee consumer was in direct conflict with its biggest supplier. Brazil fired back immediately. Its president declared he wouldn't bow to U.S. pressure, a defiant signal that Brazil wouldn't break. Global traders noticed. Contracts that once felt rock solid were suddenly in doubt. Yet Brazil's financial markets barely flinched. Its currency and stock indexes held steady, showing confidence the country could weather the storm. Washington may have pulled the tariff trigger, but Brazil showed it had plenty of leverage too. The impact was swift. Importers were forced to rip up long-standing contracts, scrambling for beans in Central America, Africa, and Asia. But supplies there were limited and far pricier. This wasn't because Brazil lacked coffee. It still produced more than a third of the world's supply. The real problem was price. The tariffs erased Brazil's cost advantage, making its beans unaffordable for U.S. roasters used to cheap imports. Practically overnight, Brazilian coffee became almost unsellable in America. If Washington expected Brazil to cave, it miscalculated. Instead, Brazil pivoted to new buyers and turned crisis into opportunity. Within days, China stepped in. Just 3 days after the U.S. announcement, Beijing approved import licenses for more than 200 Brazilian coffee companies. With its fast-growing cafe culture, China offered 1 billion new potential customers. Europe followed, with German retailers signing contracts to secure beans that once supplied American roasters. With no tariffs in the way, the EU promised stability the US could no longer offer. Elsewhere in Asia, countries like South Korea and Japan also snapped up Brazilian beans for their booming coffee markets. What had looked like a U. Consumers started to feel it. Just months earlier, a pound of ground coffee cost about $7. By late summer, it was selling for over $8, even $9 in high-cost states like California and New York. That 15 to 20% jump meant families brewing a few pounds a month were suddenly paying $50 to $100 more a year just to keep their coffee habit. On paper, it may not sound devastating, but for households already struggling with rising food and fuel costs, it was yet another burden, one that was impossible to ignore. For decades, coffee was one of those small, affordable comforts people could count on, no matter how the economy was doing. Now, it was slowly shifting into a luxury, forcing tough choices. Some began brewing more at home instead of stopping by cafes. Others turned that daily latte into a weekend treat. A few cut back altogether, while many switched to cheaper brands that just didn't taste the same. The assumption that coffee would always be cheap and everywhere was starting to crumble. What used to be a simple morning ritual was now a budgeting decision, subtly reshaping daily life for millions. Not every coffee seller felt the hit equally. Big chains had resources smaller players lacked. Giants like Starbucks, Dunkin', and Tim Hortons operate global supply networks and lock in long-term contracts, which gave them a cushion. Analysts predicted Starbucks might lose a few $100 million in profit, significant but manageable given its size and loyal customer base. For their customers, the changes were barely noticeable. Prices ticked up by a few cents, but the usual latte or drip coffee stayed within reach. For these massive brands, the tariffs were a nuisance, not a knockout punch. But for independent cafes and small grocers, it was another story. These businesses live on razor-thin margins, so a sudden spike in bean prices hit like a hammer. By early August, many shop owners saw wholesale costs jump 30 to 40% almost overnight. There was no easy way to absorb that. Some tried swapping Brazilian Arabica for cheaper beans, Robusta from Southeast Asia, or alternatives from Ethiopia and Honduras, but customers noticed. The smooth, mild flavor they were used to was gone. For neighborhood cafes, that wasn't just a minor tweak. It risked breaking the bond with regulars, and with it, their very identity. These struggles played out across the country. In Ohio, a family-owned grocery faced angry customers grumbling about higher prices, some ditching their favorite brands for cheaper substitutes. In Kansas, a small cafe owner had to cut back hours after switching blends cost them nearly 20% of sales. In Oregon, a local shop laid off 2 employees and trimmed its pastry menu just to stay open. Down in Florida, a Cuban-American cafe famous for its espresso discovered that without Brazilian beans, their signature drink wasn't the same. Tourist traffic dropped noticeably. These weren't isolated cases. They were ripples spreading nationwide. Coffee shops are more than businesses. They're community hubs. When one closes, the whole neighborhood feels the loss. While Washington turned coffee into a trade weapon, Canada quietly stayed on the sidelines. No tariffs, no fights, just business as usual. That calm approach became an advantage. With no barriers to Brazilian beans, Canadian importers had no reason to change course. In fact, they kept buying, and even increased purchases. By 2024, imports from Brazil were up more than 7%. When U.S. demand collapsed in 2025, Canada was perfectly positioned to scoop up the excess. From Brazil's perspective, Canada suddenly looked like a dream customer-strong coffee culture, predictable rules, stable retail chains, and, crucially, no tariff threats. Industry experts speculated Canada could lock in billion-dollar supply deals, securing coffee for years to come, and maybe even surpassing the U.S. as one of Brazil's top buyers. In just a few months, America's quiet northern neighbor had turned into a strategic player capable of reshaping North America's coffee map. Meanwhile, Canadians barely noticed any disruption. While U.S. prices in places like New York and California surged past $9 a pound, prices north of the border held steady. People kept drinking the same blends they always had, often unaware of the chaos unfolding just a few miles south. That stability became a real competitive edge, reassuring Canadian consumers and making their market even more attractive to Brazilian exporters. Take Tim Hortons, Canada's beloved coffee chain. With steady access to Brazilian beans, it kept prices unchanged, even as U.S. rivals were forced to raise theirs. Smaller Canadian roasters benefited too, some even expanding online sales to U.S. customers hungry for cheaper, familiar blends. Ironically, doing nothing gave Canada an economic edge over its neighbor. As this played out, global coffee markets shook. On the New York Exchange, Arabica futures jumped over 30% by late summer. In London, Robusta prices surged more than 50%. By August, Arabica was trading around $3.70 a pound, up from $2.80 just a month before. Robusta, often used in instant coffee, neared $2 per pound. These weren't abstract numbers. They meant higher costs for importers, and eventually higher prices for drinkers worldwide. Farmers in places like Vietnam and Colombia enjoyed short-term profits, but many worried, if the U.S. could disrupt Brazil, what if their crops were next? The stakes were enormous. Brazil, Vietnam, Colombia, and Ethiopia together produce nearly 70% of the world's coffee. If Washington extended tariffs to even a couple of them, the global market could be thrown into chaos. Unlike corn or oil, coffee can't be ramped up overnight. It takes years for trees to mature, and they grow only in specific climates. Processing plants and shipping networks can't just move either. In the worst case, cutting off multiple top suppliers would leave the world facing fewer options and far higher prices on store shelves. Remember to like and subscribe, and thanks for watching.